Hey, welcome to week 2 of 50 of Math.Logic.Wealth. I'm your host, Jeff Cait. And this week, in week 2, we're going to talk about the math that shapes our industry. This week, we're going to take a crucial step backward so we can leap forward. To understand where life insurance products are heading, we need to first understand the mathematical foundations that brought us here. These aren't just historical footnotes. They're the breadcrumbs that show us the path to the future. Mathematics has always been the silent architect of the life insurance industry, from the earliest mortality tables of the 17th century to today's complex universal life products. Mathematical principles have guided how we protect families and build financial security. Yet, somewhere along the way, our industry developed a culture of opacity rather than transparency when it comes to the underlying mathematics of our products. Slide 2 is about captive distribution, when insurance companies controlled distribution. In the 1800s, when life insurance companies first began operating in America, actuaries used basic probability and statistics to calculate premiums and reserves. The product lineup was beautifully simple: term insurance, non-participating whole life, and participating whole life policies. No illustrations, just a straightforward rate book that let us calculate the exact premium for whatever life insurance product the advisor was promoting and wanted the client to purchase. What made this era fascinating was its simplicity and control. Companies maintained tight control over product education and training. Think of it as vertical integration. They controlled everything from product development to how it was explained and sold to consumers. And then we had a crack in the system, the one case letter revolution. Let's explore it. I call it the crack in the system. It's a fascinating turning point in life insurance history. In the 80s, independent manufacturers started creating competitive products that challenged the traditional system. This wasn't just a minor disruption, it was revolutionary. Career agents who had only ever seen their own company's products suddenly discovered potentially better options for their clients. Insurance companies responded with one case letter agreements, essentially permission slips allowing their captive agents to occasionally sell another company's products when it better served the client's needs. Here's a slide that shows what happened to interest rate, the term to 100 story. The real game changer was term to 100 products. Back in the 80s, when interest rates were hitting historical highs, Canadian insurers developed what seemed like a brilliant innovation: a term insurance product lasting until age 100, with level premiums guaranteed for life. The math behind it was clever. They use lapse-supported pricing. The actuaries assumed that a significant number of people would drop their policies before death, just like with regular term insurance or other permanent products. Those lapses would generate profits that could subsidize the guaranteed premiums for those who kept their policies. With high interest rates, the investment income looked more than sufficient to support their guarantees. But here's what happened to interest rates. Let me show you something that really drives home why the term to 100 story matters so much. I entered the industry right at that peak. You see there? When interest rates hit an astounding 22.75%. Looking at this 77-year view of prime rates, you can see why actuaries in the 80s might have felt confident building products with aggressive guarantees. But life insurance isn't like other financial products. When we price a policy, we're making promises that could stretch 40 or longer years into the future. Think about it. Actuaries had to somehow predict where rates would go over the next 4 decades. Those high rates that made the pricing work in the 80s, they didn't just dip a little. They fell off a cliff to 3% by 2013. The industry's response? A whole bunch of things. They did enhanced whole life. They denied what was happening in the market by introducing term to 100 because term to 100 created an impossible competitive situation for traditional insurance companies. Despite clear unprofitability, many companies felt compelled to continue offering these products just to stay in the game. Think about that. Knowingly selling unprofitable products just to maintain market share. And around this time, we witnessed the emergence of enhanced whole life products. I was a product manager developing enhanced whole life products at that time with Prudential of England. And the companies used non-guaranteed dividends to purchase as much term insurance protection as they could. The goal was to mirror the attractive pricing of term to 100 products through non-guaranteed dividend manipulation. Universal Life entered as companies desperately sought ways to differentiate themselves in this price-driven market. Now, today's reality and future challenges. Today's market has evolved into what I call a B-plus marketplace. Through careful mathematical analysis, we can see that most insurance products are fairly priced within their category. For what you get, they offer a fair price with fair risks associated with it. The days of finding that single perfect product are behind us, though. Let's be honest. It would be foolish to pretend we can predict what someone's world will look like 40 plus years from now. Without concrete evidence, we simply can't offer certainty. This is why we fall back to probabilities and mathematical modeling, which strongly indicates that combining and actively managing a strategic portfolio of life insurance products offers our clients the highest probability of achieving superior results. We need to optimize for adaptability in product design because we know things will change. That's the one certainty we have. So let me summarize the 5 key mathematical insights we've explored today about how our industry has evolved. First, we saw how mathematics started simply, just mortality tables and basic probabilities with straightforward rate books that made everything clear and transparent to captive agents. And then we witnessed how the second term to 100 story showed us the dangers of making long-term mathematical assumptions about consumer behavior. Third, we learned that interest rates can break even the most carefully constructed mathematical models when we're making 40-plus year promises. And fourth, we discovered how product innovation often comes from mathematical necessity rather than marketing desire. And finally, we found that modern portfolio theory suggests combining and actively managing multiple insurance products likely offers better outcomes than seeking that single perfect product. And that brings me to something special about these sessions. In a moment, I'm going to turn off the camera and I'll join a wonderful community of advisors in my Zoom room who take time each week to dive deeper into these concepts. They're professionals who, like you, are committed to building optimal solutions for their clients. And while I can't share those discussions here, I encourage you to find your own community of like-minded professionals who share your commitment to evidence-based analysis. Sometimes, as we'll discover next week, the math isn't enough or it simply isn't available. That's when we need to apply careful logical analysis to guide our decisions. I hope you'll join me as we explore how logic helps us navigate those challenging situations where numbers alone can't tell the whole story. But thank you for joining me for this week 2 of Math, Logic,